Everything you're about to hear is for education and entertainment purposes only. Whilst we are licensed, we're not aware of your personal financial circumstances. Any advice is general advice. Equity Mates operates under Australian Financial Services Licence 540697.
Equity Mates!
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.
Equity.
Welcome back to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the first time, a massive welcome to the community. A reminder that on Wednesday, the 10th of July, we are coming to Melbourne to do a live podcast. We cannot wait. The evening is going to be highlighted by a live Pimp My Portfolio session where Ren and I will be going through our portfolios, every single position with Luke Larrative to get his thoughts on how we might be able to improve our portfolios, just like we do it with community members on the show. So if you want to see what is in our portfolios and see if Luke can roast us, then come and join us at our live event in Melbourne. We're also doing an Ask an Advisor session as part of it where we'll be bringing in Dylan, one of our advisors, where you can answer all of your questions from the night, as well as we'll be unpacking the news headlines just like we normally do on the show. So come and join us. It's Wednesday the 10th of July. Tickets are available at equitymates.com/events, and I think there's only about 20% left or so. So make sure you grab one. We cannot wait to see you there. My name is Bryce, and today I'm not joined by my equity buddy Ren, but we are back with another Ask an Advisor. And today we're going under the hood of my experience getting insurance advice. In a previous episode where we sat down to discuss insurance, I didn't have any. So today we are bringing in our insurance advisor, Phil Thompson. Phil, welcome.
Thanks for having me.
So Phil is director at Sky Wealth, and we had Phil on the show perhaps 2 or 3 months ago. And Phil, we covered a broad range of questions regarding insurance and life insurance specifically.
Yeah, and I told you off for not having insurance in place. So.
Yes. And so I took it upon myself to, between then and now, actually work with your team and seek professional advice to sort myself out when it comes to insurance. Because whilst I do have a superannuation account, my super, I didn't have any insurances through my super. And what I found out is that you can actually get life insurances through alternative means to just your current super fund. Correct?
Yeah, that's right.
Yeah. So in today's episode, we're going to go through the process that I went through with Sky and actually look at the statement of advice. And I've got plenty of questions. This is a whole new ball game for me. So found the whole process incredibly interesting. I would say very easy as well. So credit to the team. But let's start with the top and why I decided to get advice. Currently self-employed, mortgage, planning to start a family, no super fund insurance. Like, for me, that screams I should be getting advice.
Yeah, that's the highest risk investment you could ever make is if you're going to go all in your life savings in crypto, it's the same as this situation.
Well, luckily I don't do all in savings on crypto.
That's right.
But I feel like there are a lot of people listening in the community, and we get a lot of questions through around when is the right time to actually seek advice and what insurances do I need. And so this process has really helped answer that question for me. What are the type of, let's just kind of, for those that have just joined, from your point of view, when is the right time to be seeking advice? And I guess what's the benefit in seeing a professional do it?
For me, when you've got an income that you rely on, that's a really good time to start. But, there are plenty of other life events, as you mentioned, buying your first house, you got a massive mortgage. If something happened to your income and you can't pay that mortgage, well, you're selling this beautiful house pretty quickly. And when you have kids, it's another great life event when you go, well, actually, it's not just me and maybe my partner that we need to think about. It's actually, what are we leaving, for our kids and how are they going to be looked after? And then, increasing debt. Me and my wife, we bought a house 2 years ago. And so increasing debt, if your business does grow and you've got more liabilities, you've got more staff to look after, another reason why it's a good idea to look at increasing or taking out cover. And then on the opposite is true. Like if you start paying down debt, getting inheritance, that's when it's a good time to review and go, well, actually, maybe we don't need as much anymore.
Yeah, I mean, for me, like self-employed was a big driver, and we've just taken on a mortgage. So you just wanted to make sure. So I think specifically let's start at the top. I sat down with one of your colleagues, Trent, to do a bit of a goals session. And I filled in a big form, massive questionnaire, so that you could understand my goals. Clearly, they are to ensure my family doesn't lose our home if I'm injured, seriously sick, or suddenly die. That I have life insurance tied to my super fund. That the long-term affordability of the insurance premium is manageable, I guess. That I'm financially secure regardless of where we live in the world. That if I die suddenly, family's living expenses are covered. That I can afford good medical care if I'm seriously sick or injured. That I can receive income retirement. And that, importantly for now as well, that I limit the impact of premiums on our cash flow. Because I think that was a big deterrent for me to actually sit down and do it, is thinking I actually don't want to, as silly as it sounds, pay $2,500 a year out of my cash flow.
Yeah.
So for everyone listening, that's kind of what you said back to me were my goals, and that's based on the form that I filled in. The form was huge, took into account personal information, work history, medical history, life goals, everything. What do you need all that information for, and what do you do with it?
Yeah, no, it's a good question. So we kind of jokingly call that form our, obnoxiously long form, but it's super, super important. So the main reasons we need it is, we want to understand your financial world. We kind of want to know, what's your financial position, so we can then determine, okay, based on your goals, based on your financial position, how much cover do we think you need, and what are the policies that we think we're going to recommend. And then the financial information when it comes to like your work income, that does depend on, what's insurable, what's not. How do we, especially as self-employed, there's even more forms that you got to fill in because, getting profit and losses is really important. We've got to fully understand that and fully, know really deeply kind of what is your financial position. And then we ask heaps of health questions. That's kind of where we pride ourselves, asking a lot of health questions up front. So what that helps us do is we then go and take all that information, we de-identify it all, so the insurers don't know who you are, and we send it to the insurance companies, and we send it to all the insurance companies, or not all, but majority of the insurance companies, and they don't love us because we send it to them and we send them so much, but we want to get a really good, clear understanding of if we were to submit an application, how would they treat it? Would they put any exclusions on it? Would they put any loadings on the cover? Because there is a really wide variety of outcomes when it comes to insurance underwriting. And so one insurer may say, actually, Bryce, awesome guy, but we're not going to offer you cover. And another one may say, yep, all of these, issues, concerns, they're not a worry for us. Now, fortunately, in your case, there wasn't that much of a variety. There's nothing too big to be concerned about. But that's why we do a lot of that deep work up front. And it does take us time, and it lengthens the process up front. But it means that we are very confident in picking the insurance provider that best suits you, instead of just going, well, who's the cheapest, and then let's submit an application and good luck with the outcome.
Very comprehensive. I was surprised how much detail you needed to know about our business income. We were submitting balance sheets, all sorts, and I understand now, but wasn't expecting that. And I think the outcome of the insurance income protection was surprising as well. So for the community listening at home, just to be clear, what I'm looking for was income protection. I was looking for TPD, which is total and permanent disability cover, trauma cover, and life cover. So all the main insurances that you get in your default, mostly get in your default super.
Trauma is the only one that you'll never get within super.
Okay.
You can't get that within super.
Oh, so why'd you give it to me?
Well, we recommend it because it's actually the most claimed outside of income protection. It's the most claimed on insurance.
Oh, right.
It kind of pairs really well. I'll go on a little tangent.
Okay.
When we talk about health costs, people think, well, I've got private health insurance and that's going to cover me. The Australian public pay twice the amount towards health than private health insurance. providers pay when it comes to health events. So things like cancers, heart attacks. So everyone thinks, well, I've got private health, I'm all covered, they'll fund it all. But the Australian public actually fund twice the amount. That's why we see so many GoFundMe campaigns, because even if you do have private health insurance, it's not fully covering it.
Wow.
So that's why we are a big believer in trauma insurance in our business, because it funds a lot of those major events.
There you go. Wow, learning something throughout this process. So I'm going to do a quick spoiler alert as well for the community. The default cover I could have had in my super fund was far inadequate based on what you guys have recommended. The natural thing to assume there would be that the cover that is adequate is far more expensive than the default option. We'll get to the numbers in a moment, but it turns out that not only am I getting more protection, but I'm getting it cheaper than if I was to be with the same level of cover through my existing super fund.
That's right.
Yeah. So we'll get to that in a moment. But let's start with income protection. So surprisingly, you've said that my annual income from my main occupation that you're willing to cover is $85,000.
Yeah.
Now that is not my income.
Yeah.
And the biggest surprise here was that you've taken into consideration the financial performance of Equity Mates, which ebbs and flows, and you're not able to cover my full income because I'm tied to the success of Equity Mates. So when you're looking at someone who's self-employed or not, like, why is this the case? How has this happened?
Yeah, so, just to clarify, we're not the insurance company, we're not making a judgment call on Equity Mates' performance. And that's kind of the research we do. We actually send that to the insurers and say, hey, based on this, how much would you cover? And they all come back with varying stuff. Actually, to be perfectly honest, we've built an Excel spreadsheet in our business to fully understand every insurer's metrics. If something's really special, and we can go outside and go to the insurers, but we understand, okay, this insurer is going to offer this much cover, and what's everyone going to offer? And the reason being is because when you're self-employed, it's not just what dividends are you taking from the business or what is your wage from the business. It's the ownership of the business. If there's any losses in the business, will be taken into account. And then the opposite is true. If there's depreciation in the business, sometimes that can be added back into your income as well. And it's normally looked over a 2-year period. So it's a 2-year window where the insurance company will want to have a look at, okay, what have you done in the last 2 years? Because from an insurance company's point of view, they don't want to over-insure you and then at claim time look at those same financials and go, actually, we're going to pay you less. It's because you'll be overpaying premiums that you can't actually claim on.
I see.
So that's why, even though your income is higher than what your insurable income is, that's why there's a gap, because at claim time, the insurance company will only pay you if you claim today that insurable income.
And if you're not self-employed, you're just employed by someone else.
Much easier.
It's
much easier.
Present the pay slips and away you go.
Yeah. Like 90% of our clients are employed, and so we don't get anywhere near the data as financials. We actually just take their disclosures. We don't even need to see pay slips or anything, because the insurance company also doesn't need to see that.
And so what I'm essentially entitled to is a monthly benefit of $4,900.
Yeah.
Now, for me, that's pretty frightening, because that's not going to cover a lot of my expenses, mortgage, those sorts of things. So, is there anything that I can do about this, or do I just have to hope that, if Equity Mate's a wildly profitable 1 year, I have to go back and...
Yeah, we just got to go and increase it. So
numbers.
this is the judgment call today, and next year we can review your financials and then potentially increase it. Next year based on financials. So as self-employed, you can equate the profit or your percentage of the profit in the business and the wages that you take from the business and super that you take from the business, and also, as I said, your portion of depreciation. Now, if there's any kind of losses in the business, well, whatever ownership percentage you have in that loss, that'll count against your income, because effectively the insurance company sees, well, this is you and your entity at whatever percentage, and so it will have an impact. So in future, if it's wildly profitable, which we all hope as self-employed people, we all hope it is, that's when we revisit it and go in and increase the cover then.
Right. And then when am I, what are the circumstances where this kicks in? When can you actually claim claim on income protection?
Yeah, so income protection is claimable if you cannot work for health, sickness, illness. So if you aren't able to work, assuming there's no exclusions on the policy as well.
And what does that mean?
So an exclusion is if I have a history of mental health, so I've gone and seen a psychologist or I see them on a regular basis, when I apply for insurance cover, the insurance provider may say we're going to place a mental health exclusion. So if you can't work for because you broke your back, we'll pay you. But if you can't work because of a mental health condition, stress, anxiety, depression, they won't pay out on that.
Interesting. That seems a bit unfair, but I understand why they're doing it because it's pre-existing and
exactly. And the thing is, it's every insurance companies are allowed to discriminate. That's their job. That's their job. Like, you live in a certain suburb, if you live 3 suburbs off, maybe it's safer or not as safe. Your home and contents insurance may be more expensive or less expensive because of it. It's the same when it comes to life insurance and income protection.
And so in my specific case, no exclusions.
Correct. That's our expectation.
Okay. Yeah.
Based on your disclosures and what we've gotten from the insurance company, we don't expect any exclusions. We've still got to submit the application and get the policy in place before it's kind of, we're guaranteed that there's no exclusions.
Yeah. So income protection, pretty straightforward, made sense to me. Whilst it is like significantly lower than my take-home pay, there is some protection there, and that was primarily driven from the financials that I provided. Let's move to total and permanent disability cover because this is where it all started to become. And so here you're looking at medical costs, what debt I have, all those sorts of things, to come up with a figure. So talk me through it. The figure that you've given includes things like a lump sum to replace a percentage difference between income protection and income.
Yeah.
There's medical costs, which is a lump sum.
Yep.
There's a lump sum to clear my debt, which I assume which is my mortgage.
Yep.
And then there's a lump sum as well to clear any tax.
Yeah.
So this then comes to a big figure. Talk me through how that. What do these numbers actually mean?
Yeah, cool. So I'll talk about the bottom 3 because they're kind of the easiest to understand, and I'll talk about there's a lot of nuance in that top one, especially in your case. So medical costs. We've made an assumption that if you're totally and permanently disabled, never able to return to work again, you may need some money for medical costs or home improvements. So if you are in a wheelchair, maybe you need to ramp up the front step to get up, and is that going to cost $3,000? Are you going to build it yourself and cost you $200 if you go down to Bunnings?
Yes.
And so there may be some costs there. So it's an estimate. So you don't actually need to pay those bills and get a refund. It's just a lump sum that we recommend you take out to cover medical costs.
Okay.
The clearing debt is your mortgage, so the home you're living in. So if you had an investment property and you didn't have a mortgage, one of the questions we would have asked you up front, but you didn't get asked, was, do you want money to clear to pay for a house if you were disabled? And you would say yes or no. So you could select that if you didn't have a mortgage. But in your case, because you've got a mortgage that you live in, that you got a service, we want that cleared.
Nice, yeah.
And then the tax is an estimate, but TPD, if you get paid a total permanent disablement payment into your super fund and then you pull that money out, there is tax consequences of that.
Of course.
And so you want to pull some of it out because you want to pay off your mortgage, you want to pay medical expenses.
You want to keep the net.
So there are ways to minimise that tax, but we just go worst case scenario if you pull that money out today. And that's the estimated tax today.
Yeah.
Now, in 10 years' time, that tax actually grows, or the tax liability that you would have actually increases as you get older. It's a funky calculation that most financial advisors don't even know how it's calculated, but we basically go, if you got this money, what would the tax be in 90 days' time?
Gotcha. So that's medical debt and estimated tax, and that's just lump sum into the super fund. But then this outstanding one at the top, which is a lump sum to replace percentage difference between income protection, which we've noted as 85 grand a year or whatever, and income.
Yep. So
is this a shortfall?
Exactly. So every income protection policy, whether you're self-employed or not, you can cover the maximum of 70% of your income or 75% of your income, depending on the policies. So you can never fully replace your income with income protection. So for most people, we normally just cover 30%. So income protection will pay you 70%, but if you can never return to work again, we want to cover that 30%. For your case, because your income that you're living on is higher than your insurable income, we actually cover a much bigger portion because we go, well, what's your insurable income? It's 84 grand, which we talked about. What's the income that you're living off and that we expect? You know, if you could never return to work again, there's a much bigger gap there. So that's why that number is much bigger than normal.
And so that's just a lump sum as well paid in, and it's up to me how I manage that.
That's right. Yeah.
Okay, so that comes to a figure, and that's for total and permanent disability cover. Again, what are the triggers to claim on this?
Yeah, this is the hardest one to claim on. It's the highest kind of barrier to make a claim. It's if you're totally and permanently disabled and you can never return to work again.
Okay.
So, you've got to be significantly disabled, and that can be most claims at the moment are mental health claims.
And are there exclusions to this as well?
There can be, yeah. Okay. It's normally whatever your income protection exclusions are will be the same as total permanent disability.
Gotcha.
So for your case, we don't expect any exclusions.
Gotcha. So then we move to, I'll say the number. So it's telling me that there's an insurance shortfall of 4.8 million.
Which is very high. That's very unusual because of that gap. Yeah.
Because what it's saying is the gap, because the difference between my income and what I need is so large.
Correct. Yeah. Exactly.
Yeah. And so again, this is driven by the relationship I have with equity mates and whatnot. But you're saying in a situation where you're just where you're employed, that figure would be most cases a lot lower.
Yeah, we might touch on it, but the insurance company won't even offer you that much cover you want.
That was my next question.
So it is much higher than we normally see. We normally see, I don't know, anywhere between like 1.5 mil to 1.8. Because the younger you are, you actually need more disability cover because you can't, assuming you're disabled, in a year's time, you actually need more cover than someone who's 55 years old.
Right, because in the statement of advice, that's the number, the total insurance shortfall, but what's actually willing to be insured is 3 million.
Correct.
Is that because the insurance company actually are saying we don't want to insure up to 4.8?
Yeah, that's right. Yeah, so there are limits. A lot of insurance. We can go higher with some insurance providers, but we didn't recommend them. And our long-term view is, you would increase your income protection probably in the short term. So yes, theoretically today we want you to have that much cover. We've got to go and do a significant amount of underwriting to get you basically not just do your blood test, but you got to do a lot of medical tests to get $5 million worth of cover if we wanted to.
Right.
And our assumption is, hey, we're going to increase it soon anyway. $3 million, hey, it's not bad. You still got $3 million in your bank.
Yeah.
But it's not the ideal situation.
Yeah. Okay.
But most of our clients aren't getting anywhere near that cap.
Yeah, I did think it was pretty high, but now I understand what's driving that.
Yeah.
So then there's trauma cover, a little bit more simple. There's two elements to this. There's income replacement, which is 30% of 1 year's income. And then there's medical costs. So 2 lump sum payments. Pretty straightforward.
Yeah, I mean, the thing about trauma is, you talk to 10 different advisors, they'll give you all 10 different numbers on what they think trauma should be. Some people want to clear the mortgage, some people don't. So we have very simple, it's the most expensive cover, but it's the most claimed on cover outside of income protection.
Yeah.
And the reason we do $100,000 of medical costs, because we don't know if you're going to have cancer and have it for battle cancer for 3 years and not be able to work. We don't know if you're going to have a heart attack and then get out of hospital after 3-4 weeks of having your heart attack and sit here with a mic the next day.
And so what are the triggers for trauma cover?
There are specific medical events.
I was going to say, so it's not like you can claim income and trauma together?
You can.
Oh, okay.
If you have cancer and you're off work for 3 years because of it, you'll get that trauma payment.
Yep.
And you'll get your ongoing income protection payment as well.
And so they kind of net out a little bit.
Yeah, same with TBD. If you could never work again, you're getting that TBD payment as well as your ongoing income protection.
Nice. Okay. And then when it comes to my life cover, so there's a few elements to this. Income replacement for 10 years, 0.
Yep.
Makes sense. Well, when would that ever not be 0?
So we think about it if you've got dependents.
Okay.
So if you've got children and...
What about my wife?
Does she need an income?
Well, she has an income, but like if we're paying the mortgage together, for example, she'll need support with that, or?
Well, let's go to the next line.
The next line is clear debt.
Yeah. So,
true.
So that's why we don't replace your income if you and your wife, you're financially dependent on each other, and if we can be crass, if you were to pass away, it's the mortgages and ongoing living expenses. But if the mortgage is cleared, that's a huge cost out of the equation. And so given that be the case, she can then support herself with her own income. Now, if you have kids and your wife is, looking after the children, or you're looking after the children, then that has a much bigger impact on the household. So for me, my wife is currently not doing any paid work, and if I was to pass away, we want to replace my income as well for a specific period of time.
That makes sense. Okay, so income replacement 0. Clear debt, though, is to the value of the mortgage. There's 20 grand in there for funeral costs. Then you're subtracting my super balance because I'm imagining that will get passed to
that's formed part of your
whoever.
estate.
Yeah, so that's gone. The figure for life cover is essentially my debt minus my funeral costs. Sorry, my super. But you're saying that I should cover my life for $3 million. This is very interesting, though. The reason you're saying I should cover it for almost double what I need is because it's cheaper to do so.
Correct.
How does that make sense?
The reason it makes sense is because life insurance and TBD are linked together the way we do it. So if you are totally disabled, you don't have a life insurance policy anymore. And so for young people, it's pretty common, high debt, high income, young, you're going to need that income for a long time. So your disability is always much higher than your life insurance. But given they're linked, the insurance companies it's often cheaper to bump up your life insurance to match your TBD. Than it is to have life at 1.4 mil, TBD at 1.4 mil plus an extra TBD amount.
Gotcha.
So we price it both in this document. When we show you the quote comparisons, we show you if you had less life insurance, this is the cost, and then if you increase the life insurance, this is the other cost.
Gotcha.
So we because it sounds stupid. Hey, take out more life insurance. We promise it's cheaper.
Yeah.
But that's why we show you those two options down below to basically show you, hey, it's not a pinky promise. Here's the quote.
Here it is. Yeah.
It sounds stupid, but it's real.
It's true. So just to kind of wrap where we're at, so I've done the questionnaire. You've taken it away, analysed it, and then gone out to a bunch of super funds to get quotes. I then sat down with Trent, and he then presented a statement of advice, taking into consideration all of my goals, everything that I spoke about at the top, and clearly broke down everything that we just spoke about for all of the life insurances. We're going to take a quick break, and on the other side, I've got a number of questions for Phil related to what has been provided, and also I want to unpack the difference between what I've been presented and if I just stayed with my super fund, because I think that's important. We'll be right back. Welcome back to Equity Mates. We're here with Phil Thompson from Sky Wealth, doing a deep dive on the statement of advice for life insurances that I've been given. This is hot off the press, so I'm kind of talking through it as we go, which is good. I'm really getting a lot out of this, because I think the biggest takeaway for me is that top line, I knew what life insurance was. I knew what income protection, I knew the purposes of them, but when you actually see what you're actually covered for and what goes into it, it's pretty comprehensive, and the numbers were not the numbers that I was expecting. And so, this has just been a really eye-opening experience. A couple of questions that I guess have come through. So I've done this because I didn't have I didn't have cover in my super. For people that do have insurances in their super fund, is this the same process that they would go through with you?
Yeah, we go through the exact same process. The only thing that we would do slightly different is we would look at the existing cover and should we keep that or replace it. And so there's lots of reasons why we recommend people keep the existing cover. So existing cover is normally like $150,000 or max is like $250,000. It's normally really, really low. And I think Ren in our last episode mentioned that he's got, just over $100,000 of default cover.
Yeah.
So that's the default amount. Now, if you go and increase, it's you can get whatever level of cover you want. So we'll normally just consider that cover as well. Now that you didn't have it, we normally we consider it, but we know it's generally going to be priced out and also not as comprehensive as well. And so we don't kind of show you that research we did. We'll talk about it because we do a lot of that research on the back end, but we don't really show you as a major consideration of increasing your cover.
Yeah.
Unless you've got it.
Yeah. So then can you talk me through the differences between my default option versus the cover that I was insured for, and then also the difference in the premiums?
So as part of our research, we looked at if you took out $3 million with your super fund, what's the cost of that versus just $3 million of life and TPD with the insurance company we've recommended?
Yeah.
And the cost difference, from memory, it's just over $2,200 a year, or $2,264, I think it actually was.
Yeah.
Versus the insurance company we recommended was let's call it under $1,400 a year.
So about an $800 to $900 saving.
Correct.
And I'm getting, and so for the same amount of cover.
Yes.
But I'm saving $800 or $900 a year.
Exactly.
So that doesn't include income protection. So then there's a premium on top of that. What would the cover have been if I'd taken the default?
So if you just took out the default cover with your super fund, it would be $250,000 of life insurance and $250,000 of TPD.
Wow. So significantly below requirement.
That's right. And your super fund doesn't even offer income protection. So we can't even take it out if we want to.
So I think this is what we mean with the whole idea of not only knowing what you're paying for fees and all those sorts of things in your super fund, but if this is genuinely important, finding out or knowing what your actual cover needs to be and comparing that to your default.
Yeah, exactly.
Super important. I think the final piece for me was then around the cash flow, because I was just like, I don't want to pay for this. It's essentially.
Yeah.
So I was presented with a couple of options. So just talk us through the breakdown of what can be covered in super and what can't, and then we'll use my experience.
Yeah, cool. So life insurance can be paid through super or outside of super. Now, we always recommend inside of super because it's actually more tax advantageous doing it, because the super fund can claim a tax deduction for it at 15%. Versus outside of super, you pay tax on your income and then pay your premiums. TPD, we recommend that it gets split. Most of it inside of super, but a portion outside of super. And that's because we will often recommend own occupation disability. So it means if you can't do your own occupation again, then you will get paid out a TPD claim. Within super funds, you can only get what's called an any occupation. So you've got to not be able to do any occupation the insurance company can reasonably expect you to do based on your experience, based on your training, and often based on retraining as well. So the super fund, the trustee can say, well, we think you can retrain into another area because you've got experience in it. Go and do that. But own occupation is, can you do your job at the time of claim? Can you do that again, ever again? So that portion, that feature has to be paid outside of super. The other policy that
and to be clear, that that's what you advised for me is own occupation.
Correct.
Yeah. Because at the end of the day, you don't want to be forced into another job that you probably might not be able to do, but just because the super fund has that.
Correct. I mean, from my experience, I could, if I talk about death all day long, and we run a company with a whole bunch of staff and can be stressful. If I needed to make a mental health claim because running the business and talking about death all day is stressful, and I could never do what I do now, the insurance company could say, well, you could probably do admin.
Yeah.
You could actually go into another financial advice firm that doesn't talk about life insurance, just do admin, because I've done that before.
Yeah.
Or I could actually go work in a bakery, because I did that when I was 15.
Yeah.
So that's why that's why we like own occupation, but it is an option. You know, just like anything in this cover, it's all optional. Yeah. It's just where your values lie.
Yeah.
The cover that can't be taken inside of super as well is trauma insurance. So you either have it or you don't have it, and you have to pay for that outside of super. Now, I'm a massive believer in trauma insurance. Most of our claims, we just paid out $184,000 yesterday. We didn't, the insurance company did, but we facilitated it to one of our clients. Young guy, just had cancer, had surgery, he's recovering well, but $184,000. So we see a lot of those claims, but you just can't pay for that inside of super. And then income protection is a policy that you can actually have outside of super, or you can have inside of super.
I decided to put mine in super. Originally, you guys suggested it was a cash flow at about $140 a month. I really wanted that inside super. I understand it comes out of essentially my ability to max out my cap. But for me, that's not super important right now. So I'm happy for that cash flow to come out, which really reduced my my cash flow component from about $220 down to about $70 a month.
Correct.
And that's from a total of about $3,500 a year in premiums.
Yep.
Which sounds pretty significant, but I think when you look at what's covered and the ability that almost, it feels like 90% of that, even more, can be paid through super. So it's not an impact on my take-home pay. I'm happy to do that.
Yeah, and just touching on that income protection. So we put it out. We recommend it outside of super because you can get a tax deduction for income protection. Now, if your income was lower, we would have naturally recommended paying it inside of super. The way we think about it is income because marginal tax rates. You get taxed at a higher tax rate. So that's why we recommended you pay for that individually.
Oh,
however, moving it inside of super, you can still get the same effective tax treatment if you put money into super to pay those premiums.
Yes.
So it's effectively the same tax position, it's the same cash flow position, but when it's inside of super, the reason I like having it inside of super a lot is because you can choose when to pay the premiums or not. Mortgage is high at the moment. You can not contribute to your super to pay those premiums. The balance of the fund can pay for it. As life goes on, and post children and post craziness of having kids, there is a bit more cash flow. Okay, let's actually contribute double our premiums just to catch up.
So is that what you're saying I should do? I should actually be putting these premiums into my super fund each year?
You don't have to.
Yeah,
we always recommend it because we don't want your premiums to be eating away. But it's 100% a choice of your own based on.
But if I was in a default option, that's exactly what would be happening.
Correct.
Your fund is being your premiums are eating away at your.
Yeah, if you went and increase your cover with your super fund, the balance is paying for the premiums. Either way.
I have the flexibility of. Anyone can do it. You can just put money in.
Whether you go through your super to get insurance or this structure, either way, it's good practice to put money into your super fund to do it, but it's optional.
I didn't realise that the suggestion to pay outside of super for income was because of the tax implications. So maybe I'll revisit that. But
as I said, you can just put money into super to cover that cost, and you get the tax deduction, assuming you're not capping out on your contributions.
Definitely not.
Well, and you probably got carry forwards as well.
Extra contributions.
Yeah. Which, same as almost every self-employed person.
Yes.
So.
Yeah. So I think for me, just to kind of close out this whole thing, is that I think firstly I got out of it what I wanted, which was very clear. Like I tried to have a look. Yeah, very clear advice on my personal circumstances. So I feel adequately insured. There is that sense of a lot of this stuff in here is touch wood, unlikely-ish, but that's the point of insurance.
Yeah, exactly.
That is the point of insurance. And particularly at this stage in my life, self-employed, just got the mortgage. Like, you never know. So I think, like, I feel very covered. I think for me, the impact of being self-employed was a big lesson. This has not only impacted this, but trying to get a mortgage as well has implications. So word of warning, if you're looking to start a startup or go into self-employed land, like,
get your home loan and get your insurance sorted out before you
honestly,
do any of it.
Yes. Like, I think I'm fortunate that we probably started this at an age where we weren't looking to do those things. But like, if you're genuinely looking to do it, get that stuff sorted, because it is limiting, very limiting. Yeah, that's kind of a whole nother conversation. But the other goal was limiting my cash flow, and I've certainly been able to do that. But I think the biggest takeaway at the end of all of this is that the cover that I'm getting, like, this process, anyone should do, because at the end of the day, there's a small cost to do it with you. I think it was $350 or something.
Yeah, $330 for individuals or $495 for couples.
$495 to see you guys, and then at the end of it,
actually, we've just increased our self-employed after we worked on yours. No. But we've increased our self-employed costs slightly because it is actually
more work.
An incredible amount of work.
Yeah, I can understand that, like the information that you got from me. But I would also say that it was that, and then that was it. What I appreciated was that there wasn't a whole lot of, and we need this, and we need that, and you took it. 6 weeks later, came back, here's the advice. So I thought that was great. But the upfront cost was well and truly covered by the savings that you guys have put in front for the premiums that I'm getting adequate cover for. So,
and the thing is, I mean, to touch on the cost, a lot of people think, well, hey, it's expensive. People have an idea. They don't go through the process, and it's expensive. For you, let's just touch on the numbers. $3 million of life and TPD, income protection that pays out until age 65 and trauma insurance for just over $3,500, and you've got the ability to dial those costs down or to move it inside of super. Like, we can adjust it. It's not like locked in. You either take out the cover we recommend or not. Our job is, we're not the insurance company. Our job is to kind of work with our clients and go, well, this is what we think, but I don't pay your premiums. I don't ever get paid your claim. So how do we make sure we fit it into your budget or your personal preferences? And we'll give you our opinion. Like, I'll give anyone a lecture if they want to get rid of trauma. But at the end of the day, I don't pay anyone's premiums other than my own. So it's flexible. And I got a private health insurance quote, and my goodness, it's incredibly expensive to get my 60% back on my dental that I go to every 12 months. Like, this level of cover for the cost is a cost.
Yeah.
But it's, hopefully we never use it, but if we do need to, and our clients are claiming significant higher rates, it is claimed on a lot.
Well, it's a cost that a lot of people are already paying in some way, shape or form. It's just, for me, it's just making sure that you've got it right. Like, if you're paying it out of your super fund, and if you're not noticing that, you wouldn't be noticing it, to be honest, like, unless people are really going in and looking at the breakdown every year when they get their super statement. So, like, make sure it's right. That's the thing. Just go and do it.
And it doesn't matter what super fund you're with, and we can almost recommend any insurance provider that suits you. We can structure it the same way as you have, with the right insurance partner, and not just the one that your super fund is with.
Yes, yeah. Well, Phil, thank you so much for taking the time to come and unpack this all for me.
My pleasure.
It's certainly
second meeting to go through the advice.
Yes.
You got to digest it and then ask more questions, which is good.
That's it. Well, I think the other good thing as well, you give, I think, 2 months or up to 2 months post advice.
Yeah.
Is that right? To actually go away and digest it. And that's what I did. I looked at it and I said, you know what, I actually want to adjust this. I don't want to pay $220 in cash flow. I want that to be as minimum as possible. So I went back to you guys and said that, and you went away and got a few more quotes. And so the process was, I got to the end, as you just said, like, you work with the client. So I think if you're looking to make sure your insurances are right for you, within your super fund, or doing the proper process with the team at Sky Wealth, head to equitymates.com/advice. There's a form there where we'll be able to connect you with Phil and the team. Hopefully we've been able to illustrate how easy the process is, and that at the end of the day, you're going to get the cover that is right for you. I haven't even spoken about what it would be if we were in a couple or a family, but I imagine that's even more pressing, and we'll have a sort of different result. But for me, Phil, thank you so much to you and the team, and make sure, yes, if you're interested, equitymates.com/advice, and we'll connect you with Phil, but always a pleasure.
Yeah, appreciate it. Thanks for having me.
You have been listening to an Equity Mates Media production. In the spirit of reconciliation, Equity Mates Media acknowledges the traditional custodians of country throughout Australia and their connections to land, sea and community. We pay our respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. This podcast is intended for education and entertainment purposes. Any advice is general advice only and has not taken into account your personal financial circumstances, needs, or objectives. Before acting on general advice, you should consider if it is relevant to your needs and read the relevant product disclosure statement. And if you're unsure, please speak to a financial professional. The hosts of this podcast and their guests may have positions in the companies mentioned. Equity Mates Media operates under an Australian Financial Services Licence 540697.